Welcome to Macro Bites with EY-Parthenon Chief Economist Greg Daco. In this episode, Greg is joined by Patrick Quay, EY-Parthenon America's private equity leader.
Welcome to the show, Pat.
Thank you very much for having me, Greg.
We have seen a lot of mixed signals when it comes to economic activity. We have a labor market that is showing signs of a slowdown, and yet we have seen resilience. Consumers are still spending relatively freely, and we have an environment where inflation is starting to accelerate. How are private equity clients managing this environment?
There is a lot of capital to deploy into the space, whether that's in the bank market or within the private equity credit solutions businesses. I think where there's been a disconnect and we're starting to see a thaw is on bid-ask spread.
Yeah.
Our latest private equity pulse results suggested that 2/3 of general partners are seeing those start to compress. Mm-hmm. Now we're in a position where they're out looking for the next place to invest in growth.
Yeah.
I've heard that you actually have some thoughts around growth.
There are three connected pillars that form a narrow but interconnected base to economic activity. And the fact that you have affluent consumers that are still spending, but consumers at the lower end of the income spectrum are increasingly facing difficulties when it comes to spending in a higher price, higher interest rate environment. Then you have the AI CapEx boom, where businesses are really focused on driving investment in AI, in data centers, in the infrastructure, in the software, in the R&D. And at the same time, we're seeing these valuations continuing to increase, driven by other sectors that are riding this wave of strong AI activity. But at the same time, there's still tax policy uncertainty. There's still trade policy uncertainty. There's also regulatory policy uncertainty. What is the effect of all these uncertainties on the PE landscape?
Well, topics of conversation I'm currently having with all my clients revolve around the optimism around the presidential executive order allowing private equity investment into 401ks. Our estimates suggest that there could be up to $600 billion of additional sources of capital for private equity by tapping those markets. The other piece is, I think, the tariff story has started to get understood by private equity. They've taken their time, they've done their diligence, they understand where there are pockets of exposure, but now pockets of opportunity. If you are a business that doesn't have a lot of impact and your competitors do, that's a great opportunity for private equity to deploy capital. How are you seeing tariffs impact the latest deal barometer?
What it shows is actually quite encouraging. We're expecting the deal volumes to rise about 9% this year and 3% next year. And when we split it out between the corporate M&A market and the PE market, the corporate M&A market is expected to advance 10% this year and another 3% next year. And the PE market is expected to advance this year 8%, but still advance about 5% next year. Are you more or less optimistic than these numbers?
Well, I'm more optimistic because my clients are telling me that their pipelines are building. And I think as they see more quality growth assets come to market, they're going to be well placed to capitalize on those transactions. Larger fund sizes are allowing for a greater deployment of capital in specific names that can outpace growth, perhaps in a private company setting as opposed to a public company setting. I think that's a very interesting dynamic that we will probably continue to see.
If you look at year-to-date volume growth, it's up about 9%, which is a great number. But on a value basis, deals are up about 36%. We're seeing more larger deals take place. Is that really what you're seeing also from a PE standpoint?
Absolutely. You're seeing increased fund sizes, and you're not seeing the same corollary in terms of investment management teams. So the assets under management continue to rise, and there's only so many places to put them. It's interesting. I actually expect, in addition to technology, you're going to see more activity in some of the sectors where valuations have started to come down. There's great secular tailwinds in healthcare. I think another place where you haven't seen a lot of macro positivity, building products and housing.
Yes.
I think that's going to be an area where you could see some more activity. And travel and leisure is an interesting one as well, because you're seeing a much more experiential set of folks out there wanting to go take a trip. And there's been a ton of investment in AI. What are you seeing at the macroeconomic level around AI?
We're seeing essentially a strong CapEx wave that is driving the economy. partially offsetting the drag from increased tariffs that are leading to higher inflation. Now, it's not benefiting all firms and all consumers in the same way, but we are seeing about a third of U.S. economic growth in the first half of 2025 driven by AI investment. And if we look out the next few years, that's going to become an increasingly important factor in driving structural growth. And then the potential for stronger productivity growth. Are you sensing the same type of optimism in the PE space?
Yeah. Now, not all of that is going to be technology driven, but you see a significant amount of CapEx increase expected. Our US PE Pulse results suggest up to 50% of investees are looking to deploy more CapEx in future periods. Juxtapose that with the general partner community, and they're excited about it because they're looking at it as not only a productivity lever, but also a growth lever as they think about new investments that they can be making.
Imagine you were at a private equity conference and you have a couple of takeaways to give to the audience. What would those be?
First, do not sleep on AI. It's very important to figure out how it's going to impact your businesses and your investment plans. Second, do not wait to prepare for exit. Now is the time to prepare for exit and make sure that you're ready for buyer's due diligence. And lastly, make sure to engage all stakeholders as it relates to your evaluation of a retail investing strategy.
Well, thanks for those great insights, Pat.
Thank you so much for having me.